The John Hancock 3 Disciplined Value Fund has been a top-performing fund over the last 5 years and has been doing particularly well this year. Mark Donovan has managed it since it started in 1997. He's also the co-CEO of the Robeco Investment Management company and oversees its $7 billion in value stocks. Mark is joining us now from our Boston newsroom to talk about his fund, to talk about his stock picks as well. Mark, thanks for joining us.
Oh, thanks for having me, Julie.
First of all, before we get to your picks, I want to spare a quick word for sort of value versus growth at this point in the economic cycle. Over the past year, we've continued to see growth outperform value, even this year to date. If you look at the Russell Growth and Russell Value indices, when do you think that might change, given where we are right now in the economic cycle?
Well, it's hard to know exactly when the growth value cycles twist and turn and peak out and whatnot. I think, we think that as value investors, we have the long-term tailwind at our back, that ultimately the most important decision any investor makes about buying a stock is buying it at the right price. And that's been true for many, many decades, and I suspect it will be true going forward as well.
All right, so let's talk about one of the stocks that you own, and hopefully you bought at the right price. We're talking about the Gap, the retailer, of course, which has undergone some changes recently in management, not at the top, but some sort of on the next to top level, if you will. In particular, the North American president over at the Gap did depart. He was replaced by Art Peck, who was an internal candidate, who said after he was given that post that he's not a merchant. Now, what's your reaction when you hear something like that from, a retail company?
Well, I assume that Gap senior management knows what they're doing in putting the right people in the right places. I think the interesting takeaway from the many changes that have taken place at the management there is, I think management feels a certain sense of urgency, and they probably should, given that the stock, currently about $21, only trades at about 4.5 times trailing 12-month EBITDA. So it's a very, very cheap stock. And yet we think it's a very sound business that Gap runs with their core Gap stores, as well as Banana Republic and Old Navy. We by no means think this is a broken concept. It's a bit of a fickle customer base, dealing with the younger demographic and shopping tastes and whatnot. But here's a business with no debt on its balance sheet, about $1.7 billion in cash. As I say, the stock trades at only about 11 times stated earnings, and we think management recognizes that they need to reinvigorate the franchise to get the share price up, because frankly, I think this company would draw a lot of interest from more activist type shareholders if they don't get the stock price moving fairly soon. It's a good business. It's selling at, we think, a very attractive price, and if the momentum trends could perk up, I think that would take the stock price higher. If they don't, then I think that they could be in a position where activist shareholders could come in and try to shake up the culture. So I think management's being proactive.
So a J. Crew scenario, even perhaps, where you would potentially see it going private?
Yeah, I mean, J. Crew is going private at about 9 times EBITDA. Gap currently sits about 4.5 times EBITDA. So I mean, it's a big company. It's about an $11 billion market cap. So it's not it certainly has to be of size in order for somebody to come in and do a deal. And obviously that's not what we're predicating our buy decision on. But we think it's a very sound business with a long run enduring franchise that is selling it at extraordinarily low valuation right now.
Mark,
so we think it's a very nice risk reward.
Just a really quick question here, because we're going to go to break in just a sec. I'm curious about margins. I mean, like we've been talking a lot about increasing food prices here recently, but of course cotton prices have been going up as well. How much of a problem is that for Gap?
I mean, it is somewhat of an issue, although they're probably not as exposed to cotton as some of the other apparel retailers are. And so I think there is definitely some vulnerability to their margins. Their margins have been at rather high levels. Cotton will put a bit of a squeeze on them, and the company's also indicated that they probably need to spend a little more on marketing as well. So there's no question that the business could come under some margin pressure, but with the stock trading at 4.5 times EBITDA, I mean, I don't think the margins are going to get cut in half and nothing close to that. So I think it's whatever risks there are in the margin line, or you're more than compensated by what you're paying for the stock today. We've
been talking about some of your picks. We got to the gap. I want to get to a couple other of them. And I want to talk about Pfizer a little bit. This is a company that, you know, has seen its share of ups and downs. I mean, I feel for you if you've been an investor for a long time. Over the past year, it's done a little bit better, but over the longer term, it has not. For you, is this an investment in a potential dividend increase? Is it an investment in potential for stock buybacks? What's your thesis on Pfizer?
Well, I think there's a few ways you can win with Pfizer. I mean, really, ultimately, what we try to do on any stock is try to find stocks that we think exhibit the three most powerful laws of investment physics, as we call it, the three characteristics being sound fundamentals, attractive value, and positive business momentum. I think there's no question that Pfizer is a very sound franchise with a diverse revenue stream, growing presence in emerging markets, great balance sheet, all that. So it certainly passes the good business test.
On the momentum side, though, you might have a little trouble.
That's where the challenge has been with Pfizer, no question about it. I mean, for several years now, everybody's been locked in on the forthcoming expiration of the Lipitor patent. Well, we're finally there. It's happening this year. And lo and behold, the company recently gave guidance that showed that 2012 earnings, which would be the first year without Lipitor, are expected to be about flat with 2010, 2011. So I think they've done a lot to adjust the cost structure down to anticipate the loss of Lipitor. But I think the really interesting dynamic that's taking place here is the change in the CEO. It wasn't with a lot of fanfare that the new CEO came in last December. I think people were somewhat disappointed that they selected an internal guy and not someone from the outside to reinvigorate the company. But I think what his first words out of his mouth on the conference call a couple weeks ago really got a lot of investors interested again. He acknowledged the fact that the company has had a very poor return on their R&D dollars for the last several years. They just haven't been generating much in the way of new products. And as we like to say, when you're drilling a lot of dry holes, it's time to move the rigs somewhere else. And I think that's what he's doing, in that he's moving dollars away from R&D, acknowledging that they're just not generating a lot of new product flow. He's doubled the share buyback allocation from about $5 to about $10 billion. He raised the dividend by about 11%.
Right.
And so I think there's a major capital allocation strategy change going on. That's good. And then the other interesting thing going on is they probably relative to all the other major drug companies, I think they have one of the better pipelines. They have 3 or 4 new products expected to be rolled out over the next 12, 18 months. And I almost think those are a bit of a free call option for you. You're paying 8 times earnings for Pfizer today. You're getting a 4.3% yield. So clearly investors aren't paying much for the potential that some of these new products could actually generate some meaningful revenues.
Okay, Mark, thank you so much. Mark Donovan of Robeco Investment Management joining us from Boston.